affordability level as a 39-year low, and three things need to happen. First, mortgage rates need to drop 4.4%. Second thing that needs to happen is household income needs to rise 62%. That means if you're making $70,000, your household income needs to approximately jump to $125,000. Or home prices need to fall 38%. What do you think is going to break? Do you think it's going to be the mortgage rates? Do you think it's going to be the household income? Or do you think it's going to be home prices? Household income needs to increase 62%. But according to the Fed and their outlook, we've only increased 0.2%. So we are way off from getting to that affordability factor, which then leads us to the affordability of home, the home prices having to come down 38%. The credit card and car delinquencies. According to the New York Post, right now, credit cards and car loan defaults, people that are missing their payments, are at a 10-year high because inflation is squeezing them. People cannot afford what's going on. According to this article, it's saying that the defaults have risen to 3.8 for the credit card delinquencies, and car loans have risen to 3.6% in the default. And that is the highest it's been in 10 years. The increase in delinquencies and defaults are because of the tough decisions where households have to make the decision. Do I put groceries on my counter, in the fridge, in the pantry, or do I pay for that new car? And keep in mind, right now, car loans average about $700 to $800 a month. Credit card and auto loan defaults are happening, which is a sign that wages aren't growing. Americans are trying to figure out how to give their car back to the dealership. They overspent, they got excited, they spent $5,000, $10,000, $15,000 over MSRP because there was this scarcity mindset. Does that sound familiar in the housing market? In order for people to afford their food, they can't pay for their car loans and they can't pay for their credit cards, or they're using their credit cards to get those groceries. Some people might have taken a credit card out at 9%, but now the average credit card rate is 20%, and people are getting upside down more and more and more. And what's going to be next? Well, more than likely, that's going to be the homes. Check out this article. Credit card balances just grew by the biggest amount in over 20 years. People are literally being squeezed. We have been talking about this for the last almost 2 years now. I just want to show you some graphs, some actual real graphs put together by the New York Fed. So here we got the credit card, and we have non-household debt and household debt. So what we can see is the household debt is kind of flatlined for, I don't know, almost a year, right around that $12.5 trillion. We can see that the non-household debt has been increasing. And when we break down the non-household debt, the biggest thing is student loans. So this graph is the 90 plus days of delinquents. And what you can see right here is the student loan delinquencies have dropped significantly. Why? Because there was a forbearance. But that forbearance got lifted in October. So I imagine that we're going to see the student loan delinquencies start rising again. We see these delinquencies in the credit card and the auto loan sector. What is another canary in the coal mine? Well, that would be the freight, right? Because if people are buying things, and what's fascinating to me is we're starting to see freight line after freight line after freight line file for bankruptcy or shutting their doors. But we're going into the holiday season, guys. Like, we're going into the holiday season where people are spending to buy gifts and presents. Wouldn't this be the wrong time for the freight companies to go into default or to file for bankruptcy? Well, no, it's not, because consumers are having to spend their money on groceries instead of the fun and exciting gifts, toys, things, luxuries. Yellow has declared that they're filing for bankruptcy. One of these huge $700 million U.S. bailout declares, a trucking firm that got a $700 million bailout is declaring bankruptcy because they cannot make a profit. They cannot make a profit. Energy costs are going through the roof, and there's not enough people needing freight because we're not buying as many consumer goods. Another company, CFL, that's based out of California, is also shutting their doors. That's not the only one, guys. That's not the only one. We also see right here that the freight broker Surge, the Surge Transportation, has also filed for bankruptcy. And so these are just a couple of so many freight lines that are filing for bankruptcy because the consumer can no longer afford to consume because of how high inflation is. We can see that the unemployment rate hits 3.9%, which is an increase. And I would just want to ask you guys, do you know anybody who has been laid off, lost their job, or can't find a job? I was just at coffee with a friend the other day, and he was talking about how every single application that he throws in the tech sector, he's normally competing against 100 to 200 people going for that same position, because although the tech sector is supposed to be a secure job, he is having a struggle trying to find a job in the tech sector as he's continually fighting for a position? Leave it in the comments below because I am curious to hear, and make sure you let us know where that's from. What are the banks doing? What's the bank sector? Well, we know that Jamie Dimon doesn't have a lot of faith in the banking sector as he just sold off millions of dollars of shares, as we see other executives following the same suit. It's almost like they have a feeling that something's coming. They have a feeling, and so they are trying to be prepared and selling off stocks. On top of this, we have our sixth bank in November, our sixth bank of 2023 that went under. Yes, Citizens Bank over in Iowa went under. We see that the banks are doing that. But on top of that, according to this article, we have the banking sector tightening their lending standards. So right here, this is a graph. It's showing between the quarter two of 2023 to quarter three, and you can see a big jump in just in the different kinds of loans between jumbo, government, non-QM, the subprime loans, and you can see how there is a tightening of the bank standards for residential loans. If there's bank tightening, then more than likely we aren't going to see these interest rates drop anytime soon. That leads us into the affordability factor. There is good news on this. I don't want to just like bring this, oh my gosh, this is horrible. But there is good news because I want to show you this affordability index that I found. We follow an analyst, Yardeni. We've subscribed to their stuff, and they have this affordability index that they put together, a graph that's easy to follow. And what I want you to see is in September, look how unaffordable housing is right now in America. And the last time we saw this, according to Fortune, was 39 years ago. What happens once we drop below the line of affordability? Let's just go back to 2006, 2007. So we hit that unaffordability line, not as unaffordable as it is now, but then we start seeing it start ticking up. Essentially, the affordability of owning a house starts going up because people are losing their homes. Now, again, I don't want to make lightly of somebody losing their homes. When people get squeezed and there's things that are happening, affordability comes. And so as we see this pain, I do believe we're going to see the affordability come. On top of the unaffordability hitting this line, in order for the affordability to go up, and what caused the 2006 line to start going up to the affordable levels is the inventory starting to get put on the market, or people starting losing their houses and they had to sell, and people getting more realistic on what the houses should be listed for. That brings me to the shadow inventory or the ghost inventory. One of the things that I want to bring up is from the Adam Analytics. There's about 23 million homes that are investor owned. 3.5% of those are vacant homes. So that could essentially be 142 homes getting put on the market from just investors that can't get tenants in. And here just in the Treasure Valley, we're seeing that there's 14 available units to rent. That's one way that you can look at your area. Okay, what are the available rentals? What's my available inventory? Because if these landlords aren't able to get a tenant inside of their properties, then they can only afford to make payments on those houses for so long before they got to put them on. And nationally, right now, 842,000 homes are sitting vacant on the market. But let's go into the builder segment. You can also drive around your area and look, because just because there's a low inventory, maybe on the MLS for new construction, you guys driving around know that there's more inventory than that. And part of that is because builders aren't wanting to put all their inventory on the market. They're just wanting to put maybe one when it's finished or two when it's finished. If they can keep the inventory low, they can keep a scarcity mindset. And if they keep the scarcity mindset, then people feel like they have to make this payment. Let's just jump into some Land Pro data. According to this, in Q3 of 2022, there was 674 building permits in Ada County and 494 building permits being pulled in Ada County for Q3. So a year later, builders have now over 1,165 building permits in Ada County that have been pulled. So there's a sharp increase, almost a double the building permits that were pulled for Ada County. And for Canyon County, they're at 730 for Q3 of 2023. You can see that there's more permits being pulled in just our local area, but you can't just stop there. You have to see what are the finished lots, because finished lots are inventory that the builders have that they haven't quite necessarily maybe pulled a permit to start building, but they still had to pay for those lots, or the developer had to pay for those lots. Right now, if we were to jump back to Q3 of 2022, there was 6,233 vacant lots here in Ada County. Today, we're sitting at 6,763. So we see a 500 lot increase, give or take. So almost a 9% increase in the vacant lot inventory. The reason why builders sit on lots is so they have inventory to build going on down the road. Keep in mind, these builders are sitting on these lots. So they got to pay property taxes on them if they don't sell, if they don't have a build job. And they probably paid cash for this lot, or they took out financing and so they have payments going out consistently on that. There's this inventory that's sitting in the background that you don't see. And I just want to really encourage you, drive around your area, see all these different houses that may not be on the market, but they're under construction. There's many of those here in the Treasure Valley that aren't on the market, but they're currently in framing or they're under construction. And that's how you can know this different ghost inventory.